As inflation and mortgage interest rates ease down this December, the ice cold real estate market of the fall seems to be thawing just a bit. Available inventory of homes on the market is declining faster than we expected. That implies more purchases than we expected. At the end of the year, inventory always declines, of course, but the last 2 weeks have come in with bigger than expected declines. So if you continue to assume that buyers aren't buying anything, then you'd also assume that inventory would decline less than normal in December. But inventory is declining faster than I expected. So you could interpret this as good news, maybe as less dramatically bad news for the housing market. But the markets are opening up a bit as rates ease back down. I've mentioned that the second week of January is the second, third week is when we'll see the most meaningful signals for how 2023 will shape up. The thing to keep in mind right now is these so far are just a couple data points, and they're pointing a little better. They're not pointing to the market tanking from here, for example. Every week, of course, Altos Research tracks every home for sale in the country. We analyze all the pricing, all the supply and demand, and the changes in that data, and we make it available to you before you see it in the traditional channels. If you aren't using Altos market reports with your clients, your buyers and sellers right now, it might be a good time to step up. Go to altosresearch.com and book a free consult with our team, because everybody is worried about what's happening right now. They need you to help them see clearly. There's a link in the description below to connect with our team. Just a reminder, the data we cover here in these videos is national, but at Altos, we track every zip code in the country. And so you can join us to dive in for your local markets. I'm Mike Simonsen. I'm the founder of Altos Research, and here's what the data looks like for the week of December 19th, 2022. The median price of single-family homes in the U.S. ticked down to $410,000 this week. That's down 1.2% week over week, and it's precisely what's expected for the third week of December. Home prices will end the year about $400K. And that means we'll end the year with about 10% home price growth across the country over last year. Even though many local markets are way off their peak of pricing, and nationally, home prices are still up pretty significantly over last year at this time. The second week of January will be the low point for pricing before home prices turn higher with a new inventory for the first quarter. What's uncertain still on this pattern is how quickly home prices will adjust in January. So even though mortgage rates are off their highs and drifting lower, affordability is still much more difficult than last year at this time. Plus, we have economic uncertainty for the coming year. My gut is actually pretty bearish for home prices for 2023, but so far the data is holding up, at least when we look at the national view. Some of those local markets, like I mentioned, are under much more aggressive pricing pressure. Places like Phoenix and Austin their home prices are already below last year at this time. Meanwhile, available inventory is down 2.5% this week to only 521,000 single-family homes on the market. That's a bigger drop in inventory than our model was predicting. The model has been assuming that buyers are still as frozen as they were in September and October. So inventory wouldn't sell. And even when a lot of homes get withdrawn over the holidays, that would still mean total available inventory falls maybe 1% per week. But we had a second week in a row of 2.5% decline. So the bottom line here is that we don't have any signs of like skyrocketing inventory, for example, panicky sellers in 2023. Therefore, the most bearish of the housing market predictions doesn't show up in the data anywhere yet. The bearish scenario is that supply jumps while demand craters. And while we expect to see more inventory than last year, the signals don't indicate a huge jump in inventory. Inventory is 37% lower than in 2019, just 2019 before all the pandemic craziness started. You can see here 822,000 single-family homes on the market just before Christmas in 2019. Current available inventory is 60% higher than last year at this time when rates were still hovering around 3%. And Americans were buying everything they could with those bargain financing conditions at that time. Okay, back to today and the end of the year. Since inventory fell more quickly than I expected this week, the end of the year inventories will be closer to 500,000 rather than the 520 that we've been talking about recently. Inventory may fall under 500K before that Q1 bounce in the middle of January. So in this chart here, each line is a year. The dark red is this year's curve. And you can see the last few weeks at the right end of that chart where inventory's decline rates have accelerated as rates came off their highs. So you can also see that September 1st point when rates spiked from the 5s to 6s to 7s. That's when inventory spiked again also. So I remember sharing this chart back in July saying it looked like we'd end the year at about 535,000 single-family homes. And a lot of very smart people told me that was too low. Had mortgage rates stayed over 7%, it would indeed have been too low. But now it looks like we're going to end up at about 500K. Because affordability is so stretched with higher mortgage rates, the American homebuyer is proving to be very sensitive to these mortgage rate swings. So as rates dropped closer to 6% last week with the latest inflation numbers, then if they continue to drop into the 5s maybe by January, you should see that inventory curve stay pretty flat over the year. If, on the other hand, rates are closer to 7 or above, which they could be, then we will see significant inventory build during the year. So the next stop on this journey is at that mid-January checkpoint, and we'll see what things are doing in a few weeks there. Even as supply remains low, demand is also very low right now. We have 35% fewer homes in the contract pending stage than last year at this time. In this chart, each bar is a week with a total count of homes in contract. The light portion of the bar are those newly in contract each week. You can see how small the light part is growing as we approach the end of the year. Keep in mind that during the pandemic, the Decembers were unusually active. So during the fourth quarter of 2020, 2021, American homebuyers bought way more homes than usual at that time of year. And you can see how much slower the market is now than last year. The pendings, this number, will dip a few more weeks before rebounding in January. 2023 is going to have many fewer transactions than 22, of course. The signal that we're looking for is how much of a bounce do we get in January? Do pendings keep falling when they should start climbing? That's what we stay tuned for. As rates have come down and as we wind up the year, price reductions are on their normal seasonal curve down now. Homes are sold or withdrawn, and so each week, slightly fewer homes on the market are sitting there with price cuts. So you see the top line here is the curve for this year. Currently, 41.2% of the homes on the market have had price cuts. That's a good drop from last week and the fewest since late September. So that'll keep falling into the new year beyond January. And again, these are just minor signals that the worst of the potential housing scenarios are not in the data. But that trend can reverse really quickly with another spike in mortgage rates. So that's what we have to keep our eyes on. So that's all the data we have time for today. go to altosresearch.com, book a consult with our team to learn how to interpret this crazy market for the people you need to have see it now. They need you to be the expert for them. You can get your local market data. We're going to skip this video next week for the holiday, but back in action after the first of the year. This is my favorite time of the year to watch the leading indicators in the real estate data. So stay tuned in January. Look forward to working with you.